Hey everybody, good morning. Marty Mazorra, June 14th, 2012. Today's topic is titled Never Confuse Volatility with Loss. Okay. The chart below would be, of course, the stock market. Volatility, folks, would be having $100,000 in an account on May 1st, getting your May 31st account statement, watching it go down to 92. On the statement, it says -8, and you're thinking, I just lost $8,000. Well, actually, I think you'd be wrong because you haven't lost it, as they say, until you sold it. Now, indeed, you would have lost it if, let's say, at the beginning of the month, you pulled $100,000 out of your bank account, stuck it in your portfolio, bought a bunch of securities, panicked a month later, sold them for 92, put that back in the bank. In that scenario, indeed, you just lost $8,000. But again, only because you sold something for less than what you paid for it. Okay? So when you own assets, folks, as you know, if you've owned real estate and so on and so forth, they do fluctuate in value. The great thing about an equity portfolio is you can diversify greatly in lots of different areas. Doesn't mean that everything doesn't all go down, maybe to a different degree, all at once, but it does mean you have diversification. But clearly, if you want to do better than what banks and bonds have to offer these days, you've got to accept some volatility along the way. And May was the definition of downward volatility. Okay, let's talk about investors versus lenders, because you can be both, and I suggest that people be both. But an investor is an owner. An investor actually is an owner or a holder of assets. Kind of has a long-term connotation to the word investor. A lender is someone who lends money, obviously, to someone else who invests that money. So a lender could be, you would be perhaps buying a CD at the bank. Banks are investors. J.P. Morgan has been an investor. That's been in the news. I've actually talked about it myself in the news lately. But investors or banks or maybe ABC company, corporations, will promise a rate of return, an interest rate, albeit very low these days, and then they will take your money and try to make more than what they're paying you. They would keep the profits, give you your money back over some pre-prescribed period of time, and pocket the difference. Okay. Investors, obviously, longer term, have greater potential to grow their portfolios than lenders do, and I think longer term being the key two words there, so that younger people and people with stronger stomachs, people have longer time horizons, they should be, in my estimation, mostly investors. As we get closer to retirement, as we're retired, if you're a client, you'll still be an investor, you'll still own stuff because we're still going to need growth, but you're going to be more of a lender perhaps. Maybe even more so, maybe even larger percentage of the portfolio would be in lending as opposed to owning. But the owning does lend itself, if you will, to greater long-term returns or potential for greater long-term returns. The lending part of it lends itself to more stability. It's nice to have a combination of the two. I have talked here a lot about how rebalancing works and how you're always buying lower and selling higher when you're rebalancing appropriately. But folks, suffice it to say once again, as the slogan for today's presentation says, never confuse volatility with loss. You got to live with volatility if you're going to do well longer term with a portion of your portfolio. Now, just a word about lending, about bonds, because that's what I think about when I think about lending, and we do a lot of that, or we have over the years. Right now, interest rates are lower than they've ever been, and therefore bond prices are higher than they've ever been. And there's this inverse relationship, as that suggests, that when interest rates are low, prices are up. When interest rates go up, prices go down. Folks, you do not want to be, in my estimation, a buyer of bonds in this environment. When the inevitable comes, and when interest rates begin to spike, and when bond investors, current bond holders panic, that's when you want to be there to accommodate them and get them out of those positions and pick up some very good bonds at some much nicer yields than you can get today. In the meantime, you stay on the sidelines with that fixed income portion, waiting for the inevitable to happen and playing it very, very safe as it relates to the lending side. I'll stop there. Hope that all made sense. There's lots more on my blog about Europe and about politics in the U.S. and markets and everything else. Just go to the archives, and there's more than that than you could possibly want or need. But today it's really more about keeping our heads about us and really focusing on what's important. And as I said in the text leading up to this presentation, the time to own stocks, clearly, historically speaking, has been when nobody else wants them, which also suggests the time to hold stocks is at times like these. Take care. Have a wonderful day and a wonderful weekend, and I'll be back at you soon. Bye-bye.